Good morning to all dignitaries present over here, ladies and gentlemen, members, media. Welcome to the Investment Outlook 2013. Before I welcome Mr. Niranjan Hiranandani, the President of IMC, to present the welcome address, his brief profile. The Managing Director of Hiranandani Group of Companies. The group is today considered as the producer of best quality housing and commercial premises in the country. Apart from construction, the group has diversified in education, horticulture, hospitality, entertainment, and retail. He is actively associated with and holds key positions in various government bodies, private and social institutions, schools, and colleges. Some of his past achievements include drafting the state policy for slum rehabilitation in Mumbai, designed to improve the well-being of over 6 million slum inhabitants, acting as a trustee for the creation of Nathwarda Township as a heritage destination, serving on the board of Housing and Urban Development Corporation, an organization which distributes US $3 billion per annum to help the fund the building of housing for low-income families, acting as an advisor to the Government of India on housing and habitat policy for over a decade, and serving as the chairman of Housing Committee of Federation of Indian Chambers of Commerce and Industries, FICCI. On that note, please welcome Mr. Hiranandani.
Good morning, ladies and gentlemen. This is a great privilege for the Indian Merchants Chamber, and as President, I'm really honored that Mr. UK Sinha, Chairman SEBI, has agreed to be the chief guest on this function, where we look at the investment outlook. The country is at the edge. Some people say that the future looks terrible. We have a current account deficit, we are trying to manage it. There's a huge problem of oil and its costs. There's a problem that in our country we only want to buy gold as the best investment, not even real estate seems to match it, though I would love that they do it. But that two small issues actually changes current account deficit to go from 6 could come down to less than 2 if you could solve these two issues. So there are people who would look at it very negatively, and at the same time we have people who say that the future of India is in the demographics of our youth. The young population, the growing population, the working population, the markets actually make the paradigm which is different. So we look at the future in terms of the positivism. The oil which is now found in the United States, shale oil, is going to make a difference in terms of oil prices, and that probably heralds the change. But is that enough for our country to make a difference? How do we actually educate and skill the entire population of India quickly enough to match with the demographics? Next week, sir, I'm taking a delegation to China. So we did some preliminary inquiries as to what the Chinese side would be interested actually in India. And I was amazed to hear that there are 100 people, businessmen in China, who want to meet our delegation to set up textile factories in India. 100 people have shown primary interest to set up textile factories in India to a delegation, and they said this is going to be an important move on behalf of the Chinese. And would India be ready to accept such an investment? I also inquired as to what else they would like to look at. They said, we want to do big projects. And I said, how big would these projects be of their interest? And amongst discussions, we came out to the fact that they would be interested to invest $3 billion for the metro rail of Mumbai on a BOOT basis. And I was quite taken aback because I didn't think that the Chinese would be interested in such a move. The government is equally shocked over here. They're not too sure about whether to accept such a money or not. But having said that, it indicates that the whole world is looking at India in a positive outlook. And things are happening to make a generational change which we have never seen before. We had Sam Pitroda to speak to us 4 days ago in terms of the innovation that India will bring. And he spoke about the colleges and schools and education of skilled workmen that we need to do. And he said that everything that we have done for 65 years needs to be changed. I happen to be a trustee of 17 colleges in the city of Mumbai. And he told me that if you don't do these paradigms, you will be training people and educating people who will ultimately get no jobs. So you must make this new paradigm, which will be the new India. And if you make this new India, the future is beautiful. The world sees us in a positive light. Only we need to innovate, we need to change, we need to create new paradigms which are there. The investment outlook, sir, is on this basis that the new India is going to be beautiful. We are going to be leaders in the entire world. We will make that change which India demands. Our future and the next generation demands from us, you and us, all of us, to make that paradigm happen. We will make it happen. We will insist that our leaders make this change, and that is what this whole seminar is about. And sir, we feel greatly honored that you are here today to begin this talk on this new paradigm which we talk about, investment outlook in India. There are two aspects and small things which I want to add to whatever is going to be discussed today. Is just a part of my contribution to do it. One of the thoughts, sir, which I put on the table last time too, and I'd like to reiterate, is the real estate investment trust. And we would like, sir, you to reconsider and look at the REITs in a very positive light. We believe that a time has come where the REITs will make a huge difference. And we would like you to reconsider that. I know 12 years ago, SEBI did take up the view, but at that time there was not sufficient assets available on rental, and that is why it was rejected. We, sir, would like you to look at it. There's another thought. We believe that this year's the gold imports still continues at a rapid pace. We think something innovative needs to be done. The Reserve Bank of India, possibly with the gold lying in its treasury, could issue gold bonds based on the treasury lying with them and issue that to it, so that instead of gifting actual gold to your children or buying gold for your family, we could have a gold paper. If people can trust the rupee, which is there, which is not 100% backed by gold, you will certainly, definitely trust the Reserve Bank of India to issue gold bonds, which could be a multiple of the factor of gold lying in the treasury. And this could be an initiation. And this year, we could have 100% import of gold without actually importing gold by monetizing what is lying in the treasury of the Reserve Bank of India. And if that is monetized through the stock exchanges, through the banks in India, through the Reserve Bank itself, I think we could change the current account deficit from 5% to whatever it is to less than 2.5%. Because gold being a substantial contribution in the last 1 year to the current account deficit there are so many innovative ideas. I certainly am not the leader in that. The leaders are all those speakers who are going to be here today. Sir, we are very grateful to the Bombay Stock Exchange, Mr. Ashish Kumar Chavan, who is over here. Deena has been an exceptional chairperson of my Capital Markets Committee in the Indian Merchant Chamber. I'm really grateful to her for doing this leading. Mr. Anant Subramanian of the Institute of Company Secretaries of India, thank you very much for being partner in this game, and we are very, very grateful to you. Also, Mr. Arungamanan, Chief Compliance Officer of Reliance, and also Mr. Venkataraman from MCX. We are, of course, grateful to all our sponsors. The names are listed here, the MCX, Reliance, SPI, Birla Life, FinSec, our co-organizers, BSC brokers, and others. Thank you very much. And, of course, the media. This time, sir, you'll be surprised. We had a response of 1,000 people who have come to hear you speak. But there are also 450 people watching you on the web. So we started a web interface this time because the interest is more than what the capacity of this hall can take. So we are quite surprised with this, but you must realize, sir, how people believe in you as a person. Mr. Sinha, you as a leader of the SEBI, and you who will make this difference. I must thank all the speakers, participants who are here today. Welcome this morning to the new India and a great future where India will actually lead the entire world. Thank you so much. Thank you.
Thank you, sir. Before I call upon Mr. Ashish Kumar Chauhan, MD and CEO BSA Limited, his brief profile. He serves on the board of directors of Indian Clearing Corporation Limited, Central Depository Services Limited, Bank of India Shareholding, BSc Training Institute and Marketplace Technologies Limited. He has won several international and Indian awards in providing the best IT solutions for different industries. He has worked for including stock market, petrochemicals, telecommunications, etc. Currently, he serves on Central Board of Direct Taxes, PNG on Information Technology, Securities and Exchange Board of India, SEBI's Primary Market Advisory Committee, amongst others. On that note, please welcome Mr. Chauhan.
Respected Chairman SEBI, Sri UK Sinha, Mr. Niranjan Hiranandani, Mr. Tina Mehta, Mr. Ananta Subramaniam, Mr. Venkatraman, Mr. Arumugam, ladies and gentlemen, thank you for coming today, and I welcome you all to this great seminar. The full day seminar is being held in this historic hall where actually the trading used to take place with hand gestures till 1995, and now it has been converted into a convention hall. Thank you very much for coming today, and I also take this opportunity to wish all of you a happy financial new year. In fact, I got a lot of calls last 2 days calling me saying Happy New Year, and I couldn't figure why they were telling me, and I realized now what matters is finance. And everyone should be talking about the new financial year. So it's an apt timing. Thank you, Dinaben, for organizing this seminar and the first week of the new financial year. We are gathered here to discuss all aspects of investments, real estate, debt, commodities, currencies, and so on and so forth. Usually in the seminars, either you discuss only equities, never real estate, or real estate is discussed only with developers. The first time I see a complete menu, and I hope all of you will like it. It's a unique event in that sense, and congratulations to the organizing team. For me, the other part is about investment outlook. Why does a forecast matter? Why in the 21st century, it's still that we are still uncertain about future. And that is where, when you talk to the experts, they bring that confidence in you. Sometimes they also add a little bit of confusion, but I'm sure this seminar will bring a lot of confidence in all the investors in all areas. For me, technology is a change agent. Technology does change life. Technology does change societies. If you look at over the last 10,000 years, almost all the changes, even in society, have been made possible or rather forced by technological changes, whether they're in healthcare, whether in finance, whether in even day-to-day life. And some of this probably will be discussed today because technology also changes regulations. Some of the changes in regulations are actually forced by the technology. Some of the changes are forced by the worldwide events, and some of the changes are forced by the surrounding within which a particular regulatory framework works. Recently, SEBI announced a compliance framework which became implementable from April 1. BSE has come out with a new software called eBoss, which allows brokers, without spending a single naya paisa, to comply with all SEBI regulations which have recently been implemented. Our framework at BSE now is that the complexity should be at the exchange end, and the broker end, it should be very simple to operate business. So all the compliances slowly will become automated. All the trading aspects of it, where brokers used to spend huge amount of money to first implement technology and then later on spend even more as and when newer changes took place. BSE has now automated a framework by which brokers and their customers can come in and trade on BSE through a web, cloud-based framework, a mobile-based framework, and so on and so forth, free of cost. And this is where, similarly, on the back office front, every time there is a change in any exchange, any regulations, the back office changes quite a lot. And that also puts an onus on brokers to continue to spend money, especially in difficult times. And BSE has now launched a new framework for providing broker back offices on the web, on cloud, with very, very low cost for all other exchanges. That framework allows brokers to do also back office software for other exchanges in addition to BSE at very, very low cost. And so over a period, BSE has created a framework which will take the complexity away from brokers and will free them from the cost implications of changes, the regulatory and technology changes, and also free them to do actually business, concentrate on business rather than on technology. Other issue, I agree with Mr. Hiranandani when he said that world is looking at India. World has to look at India. The growth, at least visible growth, that will come out of India. Indian demographics suggest that more than 50% of Indians, that is more than 8% of world population, is actually below age 25. When these people come into the job market, they will have to invest in financial instruments. Today, less than 8% of Indian savings go into financial assets. When these youngsters come into the job market and the families are becoming more and more nuclear, they will have to invest in financial instruments, whether through pension funds, whether through mutual funds, whether through insurance, and so on and so forth. But the financial instruments are going to gain ground. Other businesses have already penetrated very, very heavily compared to what they were earlier. In 2004, I remember, I used to work in an industry called telecom. And those days, the total penetration of telecom was only 4%. 4 phones were there out of 100 individuals in India in 2003, 2004. Within next 10 years, that is by 2013, that has reached 90%. It has happened because of technological changes, regulatory changes, and cost. Costs have come down drastically, but technology has played a huge role. Regulations have played a huge role. For me, today only 1.5% Indians invest in stock markets. How do we take it to 30% in next 20 years? That will actually not only create a boom, but also create jobs. Investing in gold actually gets no jobs. Investing in stock markets get you jobs. India requires to create 1.5 crore new jobs every year for next 20 years. 30 crore new jobs need to be created, and that cannot be created by investing in gold, irrespective of whatever we think is society's good. We must be investing in stock markets, in companies, whether in services, in manufacturing, or any other way, and those companies will be creating permanent jobs. By importing $60 billion of gold, we are actually giving away around 3 lakh crore rupees or 3 lakh 25 crore rupees to outside. When FIIs invest $25 billion in India, we feel happy. When we give away our $60 billion for stones, which are of practically no use, we are still feeling happy. For me, those 3 lakh crore rupees could have created at least 3 million jobs and permanent jobs. So that is what we need to worry about. That is what we need to discuss, saying how do we basically create jobs. For me, India's job for next 20 years is to create jobs. And that is where we need to be working on. For me, this seminar, I'm sure, will be discussing all these aspects in addition to what we call headwinds and tailwinds. Mr. Hiranandani mentioned about the price of gold and price of oil. He talked about shale gas. I also firmly believe that oil prices already have come down by 10%. Gold prices internationally has come down probably by 10 to 15%. Somewhere on the line, what we see as headwinds, because almost the entire budget or current account deficit, what we call CAD, is actually explained by gold and oil. If both of them come down in prices, and even if our consumption remains the same, you will see a huge huge current account positives coming up, and that is where, for me, the headwinds could be turning into tailwinds over this year. I hope that would probably happen. Elections are now being talked about. There is a little bit of confusion about this, but every political party is working on it. I'm sure today's expert discussion, some of them will also throw some light on all these aspects. Effectively, there are many things to be discussed, and all of us will be richer by listening to the players, the market superstars who have come here to discuss, including Mr. Hinanandani. I'm sure this full-day seminar will help all of us have a better view on what future holds for all of us. Thank you very much for coming here today.
Thank you, Mr. Chauhan. Before I request Mrs. Dina Mehta, Chairperson, Capital Market Committee, IMC, to present an overview and the proceedings of the seminar, a brief profile. A stock market professional for the last 3 decades, Mrs. Mehta has been associated with several reforms in capital market, including setting of the board system at BSE, setting up Central Depository Service, streaming of Clearing Corporation, BOISL. She has been on the BSE board for 6 years and served as Vice President and President of the exchange. Mrs. Mehta is the first woman to enter the BSE trading ring and also first woman to a board member and President of exchange. Mrs. Mehta has served on several SEBI committees for past 20 years since SEBI's inception and contributed to various reforms undertaken by SEBI. Mrs. Mehta is the founder member of SAFE, Association of Stock Exchanges of AARC countries. On that note, please welcome Mrs. Dina Mehta.
Chairman Sir, Mr. Hiranandani, President IMC, Ashish, CEO BSC, President of CISI, and my co-chair members, ladies and gentlemen. It is a great pleasure to have all of you first thing in the morning today to listen to what the markets are going to be during the ensuing year. Because the very popular proverb is buy when there is a no buyer. And I think more gloom and doom I would not have seen in my 30-year career in stock markets. A continuous almost 5 years that we have had a really bad market. I think, we are at the bottom of the U. We all talk, have we bottomed out? Yes. Yesterday only we had a lecture by Mr. Rathi at IMC. And several more lectures we talked that we have bottomed out. So I think this time is very appropriate to organize a program like this today to give an idea of what the asset classes are going to perform and what is the outlook, essentially the factors which will affect the different asset classes during the year. To talk briefly about the proceedings today, I think what we have tried to do, normally we have experts who are studying the markets who come and give their views. But we try to do things little differently. We have actually called the players who are actually buying and selling various commodities, real estate, shares. So we have got people across almost a 360-degree view. We have Mr. Chatterjee from ITC, who is one of the biggest buyers of, I think, grain and other things. We have Mr. Kalyan, all the boards that you see all over the town of Kalyan Jewellers. We have their chairman, because they are going to sell a lot of gold, which is adding to the deficit that we talk about all the time. Then we have Mr. Savos from Reliance. He is the head of global trading, and he spent almost 25 years with British Petroleum. He is one of the biggest buyer and seller of petroleum and petroleum products all over the world. So that way we have tried to get together people. We have Mr. Sharma, who is I think number 2, and we'll have Mr. K.K. Mistry, who is number 1 in housing finance. And I think between the two of them, they would cover almost 70% of the housing finance market. So this way we are trying to give a view of the entire spectrum of what is happening in various markets, and I'm sure all of you would really benefit from the deliberations which to take place today. To briefly talk about the IMC Capital Market Committee, we have just 2 objectives in mind. Our first objective is to bring markets and products to the investors. We want the investors to be aware of various markets which are available and which the products are available. So under that mission, we had programs like FII outlook of the Indian market. We had growth opportunities in volatile market, so that the markets are brought to investors. We talked about trading in derivatives. We talked about algo trading, and we also talked about funding of SMEs. Then our second objective is to bridge the gap between the market participants and the regulators. because there are many issues where, which today the power of regulation, I do not know how much is realized, but we have a huge power of regulation. You have one STT, which is STT is put on securities and STT is not put on commodities, and you have the entire business shifting. The huge volumes suddenly go up in commodity. Of course, today we have CTT on commodities also. Similarly, if there is a newspaper item that SEBI is asking for declaration under pledged shares, and suddenly companies who have, pledged 80%, 90% of their shares, their price come down. Another very big, regulation change which we are going to see is, these illiquid scripts which are going to get traded on the call option mode. That is again going to have a huge implication on how the entire mid cap and small cap stocks are getting traded. 25% compulsory dilution of shares. I think that is a major thing, because in this whole year, major activity that we are going to see is going to be the disinvestment which government is going to make, besides the other companies who are also trying to comply with the 25% regulation. So, these are, increasingly volumes and prices are not just driven by the merit of the underlying stock, but they are driven largely by the regulatory framework which is guiding these shares in a particular direction. So I think, we are having a very major role being played by the regulators, and that is going to, continue to be there, I think, in next 2 to 3 years' time. So in the last session, we have got disinvestment secretary also with us, who would be talking, because this year, I think, maximum paper is going to come from the government, and it is going to influence the market in a very big way. So these are, the initiatives that are guiding the markets today. Therefore, we had several programs during the year to disseminate the various legal changes which have happened during the year, various circulars which have been issued by SEBI. So we took up all the regulatory changes which happened, and we also, major seminar we had was on discussing the advisory regulations. And of course, we had a seminar on consent term regulations also, because a huge change has happened in the consent term regulation. From being a very, very dynamic and I would say active machinery which was set up by SEBI, suddenly with the changes which have happened, I think the use of this framework has fallen drastically. And when we analyze the entire thing, I can sum up the whole change in just one sentence. And we shifted the wisdom of SEBI panel on accepting the cases to having a list of laws under which cases would not be accepted. I think that wisdom which SEBI had collected between 2005 and 2012, and that framework, which because of SEBI's wisdom had become very effective, I think because of the changes, we suddenly have a framework which is really not as dynamic as it was before. So I would now request our President, Mr. Hirandan, to hand over our consent paper document, the entire review. And sir, we have gone one step forward. We have drafted the new regulation also and giving you a copy of that, so that you do not sir, please hand over. So you have, sir, a ready-made a ready-made document which is available to you, which is completely drafted also, and it can be implemented, I think. Though, as I said, there is only one change which has happened, that the wisdom of SEBI panel, I think we need to trust, and we have trusted the SEBI panel in past, and we need to do that in future also. Sir, our next agenda also, as I said in my earlier that the influence of SEBI's initiatives have been very vast, and therefore we have commissioned a study, our knowledge partner, FinSec Law Advisors. They have prepared a research paper on the cost-benefit analysis of various regulations which have happened in the last 3 years, and what is the benefit that we have got as a system. For example, of course I don't want to speak what Sandeep is going to talk, but dematerialization has been a real boon to the entire market, and how the shift has happened. So we would also be doing this study every year on a rolling basis, last 2 to 3 years, whatever regulations have happened, because judging a regulation in a 1-year time frame is very difficult. So on a 3-year rolling basis, we will go on doing a cost benefit analysis of how the regulation is impacting business and who are the people who are actually benefiting out of it. So now I call upon Mr. Sandeep Parekh. Sandeep has been the Executive Director of SEBI, legal head, and now he has set up, he is the founder of FinSec Law Advisors, who have also been our knowledge partners. And I would invite Sandeep to share his findings on how the cost-benefit analysis has happened with the Indian regulation. And of course, the document is available in all your kits. We are also talking about the experiences in US, UK and other countries as to how they have gone about assessing the impact of regulatory interventions. Sandeep, please come over.
Thank you, Beena Ben. It's always a pleasure being at an IMC conference. We could build a car which is made of titanium, much stronger than what we have today. It can last for 200 years. The best quality there is. Okay. We could build a car which is made of titanium which can last 200 years. Which would be the best car ever made. Unfortunately, the costs of making that car would be too high, and there'd be only 10 cars in existence if we were to have that benefit. So I think it's really important in any field, not just in the field of regulation or in financial regulation, to have a cost-benefit analysis of any incremental regulation. And I think to give you a financial sector example, I think all of us agree that annual reports, annual financial statements are a great idea. Few of us would agree that a weekly financial data by listed companies would be a good idea. So what is the cost benefit analysis? Is quarterly numbers which are out today, are they a good idea? Is a semi-annual thing a good idea, which is kind of getting in, at least in discussion tables, people are discussing about how quarterly earnings is driving short-term performance, and therefore there should be semi-annual financial reporting. So clearly there are costs, there are benefits, and each has to be weighed before drafting new regulations. And regulatory impact assessment is nothing but cost-benefit analysis of new regulations along with public consultation. And remember, doing nothing is a choice. You don't have to pass new regulations. And it's important to look at alternative regulatory approaches. And finally, on this point, regulations end up being sticky, which means once you draft a bad law, it's very, very difficult to repeal that law. And of course, we've seen laws which have been drafted 50, 100 years old, which are still in existence. So some of them are kind of completely outdated, but it's extremely difficult. So therefore, all the more reason to do a cost-benefit analysis, not just at one point of time, but on a periodic basis, every 3 years, 5 years, 10 years. SEBI obviously has limited resources. It's 500 people strong. It's not a massive organization. So you can have regulations, you can have SROs self-regulating or semi-self-regulating, or you can have complete self-regulation. So for instance, regulations, recently SEBI came out with M&A norms, where listed companies have been taking too many liberties, and SEBI's come out with several norms to restrict those liberties. We have SRO regulations, which is again a good example where we need SRO regulation is brokers. Brokers are inspected by 3 stock exchanges, 3 clearing corporations, 2 depositories, and SEBI itself. Complete duplication, 9 times the duplication that is required. So I think it's an area where SEBI needs to kind of actively promote an SRO model. And finally, self-regulation, things like the company's bill talks of CSR and the 2% contribution to CSR, and clearly that's something which the cost-benefit analysis has been looked at, and the Parliament has decided that the costs are too high to make it mandatory, and therefore they made it into a self-regulatory system. Now, a cost-benefit analysis has to start with who is affected, both positively and adversely. Clearly, investors will typically be benefited by most regulations, and companies will have additional costs, whether it's in terms of compliance costs, or whether it's in terms of monitoring, creating new systems, taking up of management time, capital, legal advice, etc., and record keeping. So clearly there are costs involved. There can be unintended consequences. You want to regulate X, but Y also ends up bearing a large cost. You need to look at likely rate of compliance, because if a law is not enforceable in reality, it's probably not a great idea to bring that law in the first place. In this cost-benefit analysis, clearly there's no precision required. It's because typically benefits cannot be calculated with exact certainty. You cannot put a number to what is the benefit of a quarterly financial number. But I think you can have good analysis, you can have questioning, you can have impact analysis, you can build in assumptions, and then throw them out in public domain. Seek public comment on which of course SEBI has been doing for since the longest of times, and give that information and assumptions. And people, including people who are adversely and positively impacted by these regulations, they will kind of point out the faulty reasonings, if any, and faulty assumptions, if any. In the paper, we discussed about 2 or 3 different types of costs. One is, of course, direct costs, which I mentioned, of monitoring new systems, etc. There's cost on regulators as well. If SEBI wants to regulate investment advisors or distributors, clearly this is going to impose a huge strain on its limited resources. And there are indirect costs. A particular regulation can have the unintended consequence of limiting competition, curbing innovation, creating moral hazard, and I can think of at least 1 or 2 examples where SEBI's maybe not gone in the right direction. For instance, prescribing net worth for investment advisors, in my opinion, is completely unnecessary, because you want smart people to give advice, not rich people. And I think SEBI needs to revisit all the regulations in which they prescribe net worth limits where capital is not should not be a requirement. So I think it imposes entry barriers which do not particularly have a good reason. We need to ask in this analysis who bears the costs and are they acceptable. And obviously we need to look at long-term costs and long-term benefits. You can't just look at what is going to happen in the next 3 months. A good example is DMAT. It imposed incredible pains in the late 1990s on all participants. A lot of people protested, saying it's too fast. But I think the long-term benefits have been incredibly, it's there for all to see in terms of the benefits which have accrued. In fact, internationally, when people do cost-benefit analysis, they actually do something like a discounted cash flow. So they actually discount the benefits over the next 10 or 15 years. They discount all the costs of the next 10 or 15 years and look at whether the benefit exceeds the cost. If so, pass the regulation. If not, junk it. Just a quick word on 2 or 3 countries. Australia, UK and US, all of them have very robust systems of cost-benefit analysis or regulatory impact assessments. And in fact, in the US, major ruling of the SEC was struck down because the analysis of cost-benefit was not robustly done, which is the famous roundtable case. And finally, coming back to India, FSLRC, which just came out with its report last week, has emphasized this in clear, unambiguous terms that cost-benefit analysis has to be part of every new regulation making, and so has the so has the Planning Commission spoken about it. So I think just to kind of give a little context, SEBI, of course, in the past, they've done RIAs in several cases. It's not a routine systemic thing, and I hope Chairman SEBI is going to look at implementing RIA in every regulation which comes out. Thank you.
Thank you, Sandeep. I now request our President to hand over the booklet on regulatory assessment. Yeah, okay. Yeah, okay. Thank you so much. Now we come to the last but one agenda, and that is to hear SEBI Chairman. Those of us who are for a long time in the capital market have seen Mr. Sinha work as part of the Ministry of Finance. I think every aspect of the financial market has been, has been part of his portfolio, be it capital market, external commercial borrowings, ECB, pension reforms, foreign exchange management function, and banking division, and various monitoring various financial institutions. So I think a whole gamut of everything that has to do with financial market, Mr. Sinha has touched base with that. Former to being the SEBI chairman, you all know he has been chairman of the Unit Trust of India Mutual Fund. So we cannot, tell him as an armchair bureaucrat, because he has been on the other side of the table also and experienced the regulatory pressure as being part of a mutual fund head. And, I have been fortunate to have interacted with all the SEBI chairmen right from 1988, even before SEBI was, set up as a legal entity. And I think this is the first chairman who actually undoes what SEBI has done. Because there have been cases where, a lot of smoothing out has happened. Because typically what we see with the regulators, and not with just SEBI, with all regulators, is that every crisis has a circular. And that circular, though the crisis gets over, that circular always remains on the paper and part of the regulatory framework. But with Mr. Sinha's coming, we have seen how KYC norms have got really loosened out, so that people who are genuinely, who would want to participate in the market, they don't have a big overload of signing so many papers. We have seen the mutual fund entry load, etc. Compensation which was given to the mutual fund intermediaries have been, become a lot more remunerative for the mutual fund intermediaries. So in this manner, in fact, I was really pleasantly surprised when in one of the seminars, one head of one mutual fund, he stood up and said, "Sir, everything that we wanted has been given. Now it is only up to us to deliver and get more people getting the mutual fund unit." So, this is the level of responsiveness that we have seen with Mr. Sinha. Sir, I would now invite you to kindly give your views to our audience. Thank you very much.
Mr. Niranjan Hiranandani, President IMC, Mrs. Deena Mehta, Chairperson of the Capital Market Committee, Mr. Ashish Chauhan, MD BAC, Mr. Anant Subramanian, Mr. Arumugam, and Mr. Venkatraman, invited guests, ladies and gentlemen. It is indeed a matter of honor for me to be here with you today. I was here last April also in your conference, and in my current assignment, it's my job to be attending various conferences. But this is one conference where immediately after the conference was over, the chairperson of the organizing committee and the chairperson of the Capital Market Committee, she immediately,
almost within 2 to 3 weeks, came out to SEBI and handed over to us the recommendations and the deliberations of the conference. I would like to acknowledge that this is a practice which is not prevalent in many of the committees that I attend, many of the conferences and seminars that I attend. People invite you, people have discussions, but there is absolutely no follow-up. And like Mrs. Mehta told you, we have been interacting for more than 10 years now. So not only that she met me after that, she continued to pursue many of the things, and I won't get into details, but some of the recommendations which were made by this conference last year have already been implemented by us. So I would like to compliment IMC and Mrs. Mehta in particular. I am also enthused by some of the observations made earlier that we are finding that there is great amount of interest outside India in the Indian market. I fully endorse it, and there are data to support it, that foreigners are taking interest in our market, in our economy. But I am also worried that while on the one hand we are having very robust FII flows, why is it that the domestic flows are either stagnant or negative? Some of the things which all of us notice, but just to set the context, you might be noticing that if you look at the 1980s and the savings rate in the country was less than 20%, it went up to 23%, then it further went up, it crossed 30%, and it had its peak around 37-38%. Again, it has started coming down. And you all know that the household savings used to constitute about 3/4 of the total domestic savings. That percentage has also come down to around 70%. From about 75%, it has come down to 70%. And amongst the household savings, we are finding that the share of financial products as a percentage has started coming down. From a high of about 55%, it has come down to around 35-36%. So the question we must deliberate, and I have gone through the total schedule of the meetings that you have today. You have excellent sessions, you have excellent speakers, and I am sure you will be able to deliberate on these issues and come out with your recommendations. And those recommendations which concern SEBI, I am sure like in the past you will be sending it to us. But you know, the general perception is that there are villains, and those villains are taking away the investments into the financial markets. And the two villains are real estate and gold. Yes, partially that is correct. But to say that the lack of investment into the market is being explained by investment in gold or investment in real estate does not give the complete picture. I think the story has to be taken to its full length, and there may be other areas about which we should start worrying. One area that I would like to point out, and it concerns me as a regulator, and it concerns all of you as citizens of this country, or as intermediaries or players in the market, or as pure investors, is the rapid development of a grey market in investment in this country. I'm not sure whether you have understood the dimensions of what is happening today. And the audacity with which it is happening, the frequency with which it is happening, is something all of us must take note of. I would like to tell you that the people who are investing in these products are simple, ordinary workers. They are not putting their illegal or illicit money into this. They are putting their hard-earned money into this. But the process through which it is being channelized is unfortunately taking that whole money out of the legal framework, out of the market. There is a famous case, I need not name it, where a particular company has claimed that it has refunded more than 20,000 crores to so-called investors, out of which more than 90% has been returned in cash. I would like all of you to ponder and think how feasible, how credible this story can be. That more than 20,000 crores have been refunded over a period of maybe 3-4 months, not over a period of 5 years or so. And that money has been returned, 90% and more than 90% has been returned through cash. I am aware of things which are happening, for example, in West Bengal. More than 10,000 crores of money has been raised by so-called money circulation schemes or people who, in our opinion, are running collective investment schemes, but they are refusing to be under any sort of regulation, and they are completely out of bounds so far. I'll explain to you what we are trying to do about them, but I'm trying to first tell you the dimension that we are facing. I met the chief minister of one particular state in the northeast, and he told me that one particular company was able to raise, more than 1,000 crore from his state in 1 year, whereas the total assets under management of entire mutual fund industry in that particular state is around 900 crores. One company was able to raise 1,000 crore in 1 year, and if you start counting from 1964 when UTI was created, so we are talking of more than 4 decades, and the entire AUM is 900 crores. So when we choose to ignore these things, I don't think we are going to get the complete picture about why investments are not happening and where are the savings going. This is actually a very serious matter. In 1998-99, the Parliament came out with a new section in the SEBI Act, and Section 11AA was added, providing for collective investment schemes to be managed and regulated by SEBI. But by design, that section has several exceptions. Nidhi schemes are exempted. Chit funds are exempted. Cooperatives are exempted. And in many of these areas, state governments have also got their rights and jurisdictions. Unfortunately, that seriousness is not coming about. I'd also like to tell you that people are coming out with such ridiculous schemes. I don't know, you have heard of this bird called emu. So there is a scheme on emu farming, there is a scheme on goat farming, and hundreds and thousands of crores are being raised through that. However, SEBI has taken note of it. We must have started prosecution or action against dozens of companies like this. We have been writing to the state governments. We have been fighting court cases. One particular example I'd like to tell you is that as per the SEBI Act passed by the Parliament of this country, any quasi-judicial action taken by SEBI can be appealed before the Securities Appellate Tribunal. And against that tribunal's order, you can go to the Supreme Court. So on the appellate side, on any action done by SEBI on the appellate side, even the high courts do not have jurisdiction. I'm not contesting the jurisdiction of high courts in the normal course, and including in matters, for example, the writ jurisdiction. But otherwise, it is SEBI, SAT, and Supreme Court. And I have examples where at least 7 district courts in the state of West Bengal have passed injunction orders against SEBI. So while on the one hand the legal position is very clear as passed by the Parliament, district courts have passed orders against SEBI. When we have said that such and such company can't raise this money, they must stop raising the money, they must return the money, they have got injunctions against the district courts. I'm happy to tell you that we have got now those injunctions vacated. We obviously had to go to the High Court and the Supreme Court, and we got our way. But in the process, what has happened, that they continued with their activities. So more and more workers, more and more savers came into that fold. Unfortunately, that could not be stopped. You might be aware that there is a law called the Price Cheats and Money Circulation Banning Act of 1978. You will be surprised that while the act was passed in 1978, an order, a rule regarding what is called the disguised money circulation scheme, that rules were framed only in 2012, while the law was passed in 1978. And that also happened after SEBI took it again and again and again. So that has now been passed. The rule has now been framed. And let us look at what is being offered. I was in Kolkata recently and I was told by industry captains. I had a meeting with the CII there, I had a meeting with another chamber there, and they told me that the agents are charging up to 15% to 25%. That is the commission that they are charging. And these schemes are offering that their money will be doubled in 3 years. You ask yourself that what legitimate business activity in our country can generate this sort of a return, where initially 25% is going out as a commission, and in spite of that in 3 years the money is getting doubled. What is going to be the outcome? The outcome is going to be that people are going to lose that money. So I want to mention all this because there is a strong need today to create awareness about these matters. That awareness is unfortunately lacking. And I also must tell you that already there are now moves and developments in various parts of the country where people have now started protesting. So it is no longer a matter to be discussed in a seminar like this. There is a place called Alipur Duar, and in Alipur Duar, some guy was running a scheme where he had promised, can you believe, that the entire money will be doubled in 15 days? Doubled in 15 days. And what has happened, that people have become very angry, they have resorted to violence, those violence have been reported in the press. At last the state government had to take some action. The anger of the people have been also coming forward in places like Durgapur, in places like Malda, places like Balurghat, and also in Cuttack. So this is quite natural. It's only a matter of time when the fraud, if I can use this word, the fraud is exposed. But my purpose of mentioning all this to you here is that all of us need to go out of this room and create awareness about it. On our part, we are going to do that. On our part, we are fighting that battle. We'll continue to fight that battle. As a crude example, it reminds me of dabba trading. Like, if there is a market, if there is a well-regulated market, people are not coming there and they are going outside that and they are doing their trading, somebody has to stop it. But somebody has also got to create that awareness. Otherwise, the whole structure of the market will get completely demolished. And when I am telling you the numbers are in the range of 1,000 crores, 10,000 crores, 20,000 crores, and in 1 year one company raising more than 1,000 crores, you will appreciate that these numbers are no longer insignificant. There will always be in this country or maybe in any other country some small examples. The point I am trying to reiterate is that these examples are no longer small and these need to be taken serious note of. Now we in SEBI, we are trying to create awareness about it. We are also trying to reach out to people in various parts of the country. In the last 2 years, we have opened 10 offices. We didn't have offices beyond the metros. We have now opened offices in 10 places, and we have recently decided that we are going to open 6 more offices. So now we have offices in Hyderabad, we have offices in Guwahati, Lucknow, Bangalore, Jaipur, Bhubaneswar, Indore, Cochin, Chandigarh and Patna. And going forward, we are also going to have offices in Srinagar, Shimla, Dehradun, Raipur, Ranchi, Goa. So our idea is that even if there is not enough money being raised for the market, because when we had an internal debate, the point was that why should we open these offices? There is hardly any investment from these places. And our argument was that that is precisely the reason that we should be opening the offices. We need to create awareness. We need to go towards those places where people have not yet started investing. And when we are opening these offices, for example, we opened an office in Kolkata, and some of the examples that I gave to you, we were able to tackle because we have now strengthened our office in Kolkata. That is how we could get all these developments. So we are starting to open our offices in almost all the state capitals in the country. But if you want to understand what is SEBI's main approach, what are we trying to do, what are we trying to achieve? The first thing we are trying to achieve is to generate trust in the market. We are trying to generate trust in the regulatory environment. And for generating that trust, and I'll come to a point which was made about cost-benefit analysis. I will be very happy to deal with this, but kindly try to understand that for us as a regulator, it is very important that the trust in the market is retained. Most of you would be aware that we had instances in the past where because of certain amounts of misconduct, that trust was eroded. And whenever that trust got eroded, it took more than 5 years, in some case even 10 years, for people to start looking back into the market. So if that trust is not restored, I don't think SEBI has a right to exist, and I don't think all of you who are present here have a right to continue with your business. So whatever we are trying to do, we are trying to do it from that particular point of view. Obviously, there will be questions of striking a balance. And I fully appreciate that this balance has to be struck. And we in SEBI have a very strong mechanism of consultative decision making, consultative regulation framing. In fact, I was taken aback when Mrs. Mehta said that she has started drafting regulations. She will put all of us out of job now. We have a very strong mechanism of consultation. And whether you look at our SAST regulation, you look at our stock exchange regulation, it has gone into serious amount of deliberations over months and months and months. But obviously, we cannot accommodate, no regulator can accommodate all the points of view, for the simple reason that there will be points of view which are contradictory to each other. And then it is our job to take a final call, which we will try to do. Some of the things which we have done, for example, in the IPO market, we have been very conscious that we should be striking a balance between the need of the corporate India to raise capital from the stock exchanges, from the market, at the same time how to attract the retail investors. We are talking of cost benefit. But are we also realizing that 60,000 crores of fundraising, the proposals have been dropped and shelved in the last 3 years? Corporate India, which were planning to raise money, they either filed their papers, or even after their papers were filed, they withdrew, or when SEBI's final approval was given, sorry, I shouldn't have used the word approval, when SEBI's final comments were issued, at that time they decided that the approval will be allowed to lapse. They allowed it to 60,000 crores. That is what has happened. If you look at the data for the year 2012-13, if you take out just one IPO, then the total money raised, equity money raised in the country in the whole of 12-13 is around 1600 crores. Where are the investors? SEBI and all of us have to work together to ensure that investors come back to the market. And that is why we have come out with several regulations, several changes in our IPO process. We have started, for example, this practice of track record of the investment bankers to be disclosed. I am sure that community or some of them in that community would be unhappy with SEBI, that this is perhaps a practice which is not being followed in any other part of the world. But if again over the last 3 years, 2/3 of the issues are trading below the issue price months after months after month, so there does arise a serious question about what is the approval process and what is the due diligence which has been done. Not 1 or 2 or 5%, more than 2/3 of the issues which have come out in the last 3 years, if they continue to trade below the market. We did a further study that, okay, they are trading below the issue price, let us adjust it for the general decline in the market and then see what happens. And we found that even after making adjustments for the general decline in the market, these issues are trading below the issue price. Obviously, we can't allow that to go on. So we have placed some restrictions on the investment bankers that he has to have a very robust due diligence process. He has to have his due diligence record for inspection by SEBI even after the issue has come out. We have said that the price must be disclosed not 2 days before but 5 days before. I'm sure some people will be unhappy. I'm sure some people will complain that it is very costly. The benefit is less and the cost is high. I'm sorry, I don't agree with that. It is our duty to ensure that we attract people. We have also, for example, provided for the IPO rejection criteria. In the mutual fund, and Mrs. Mehta mentioned to you about the demands of the industry and what all we have been able to do that. But the question is, when you try to assess the cost versus benefit in a short time frame or a long time frame, that is the real test. Any regulator, when he tries to do something which he feels is right, which the regulator feels is right, after of course consulting every stakeholder, I'm not arguing that he should be working in a huff, but after he does it, one mistake which is done generally by the market is to start evaluating it in the short run. And I will take an example again from the report which has been presented just now. On the one hand, a case has been made that dematerialization was a great success, was a great initiative. But it has also been mentioned that dematerialization initially met with lot of resistance. It created lot of difficulties for people in the short run. So my request to all of you would be that if you are evaluating any regulatory measure, don't evaluate it in the short run. Give us some time and then evaluate it. And after that you find that what we have done is not correct, please come to us. We are ready to change it. But give us some reasonable time. We are not saying that we will not reconsider any matter. An example has been given in the report about distributors regulation or investment advisors regulation, and they are completely unnecessary. I would like to be advised, SEBI would like to be advised that if there are multiple examples of mis-selling which have been going on for years together, what should SEBI do? Should SEBI keep quiet? Or should it do something at least to create an awareness about it and create some soft regulations for that purpose? And this has not been very easy. I'm talking of the investment advisor regulations. Because many of the agencies which are advising on selling on the financial products, they are also regulated entities of other regulators. For example, there are banks. So it has not been very easy. to take all the regulators on board and then come out with those regulations. A mention has been made about the consent mechanism. I would like to, I find that in one place in the paper, a point has been made that words like serious violations have been made. So the definition of serious is not given, which means it can lead to subjectivity, which means it can lead to discretion. But in the very next paragraph, it has also been mentioned that why are we having very hard and fast set of exclusions? Either the first argument is correct or the second argument is correct. And let me assure you that even in the past, before this new consent mechanism came up, SEBI was on the average rejecting 1/3 of the consent applications. The rate of rejection was 1/3. But what was happening, that it was entirely discretionary. If I am a SEBI official, I like your face, I do something else, I don't like your face, I do something else. What SEBI has done now through this revised consent mechanism is, it has set out that there are certain offences which are so serious that they can't be consented. So instead of deciding it on a case-to-case basis over a negotiation in a closed room, we have published it to the whole world that here are a set of 10 regulations, 10 offences which cannot be consented. And we have taken this idea from the criminal administration in this country. The criminal law does provide that certain offences are compoundable and certain offences are non-compoundable. What is the harm in being transparent and saying it to the whole world right now? If somebody is attempting something and he has on the one hand the comfort that he can get away with it by having a settlement, and on the other hand he knows that this particular offense which I might commit today or tomorrow, I will have to pay for it, it cannot be consented, what is wrong in it? So long as it is transparent and it is uniformly applied. However, if at all, and we have about 1 year of this mechanism in place, I would like to inform you that in the 7-month period that we had, we have already rejected about 150 consent applications. However, if there is any feeling in any corner that there needs to be a relook at it, there needs to be further changes in it, please feel free that SEBI would be more than willing to listen to your points of view. And in that context, I'll come to the point made by the president of IMC when he said that REITs should also be relooked, because he had made this point last year also when I had come here, and I had informed him in this room that this request has already been rejected by the SEBI board. I would like to assure all of you that whenever there is a case made out for a new product, SEBI is willing to consider it. You might have seen it that in the current budget, an announcement has been made about the debt market and how the trading will happen on the stock exchange platform. This was something which was being debated for more than 10 years. I remember during my days in the ministry we were discussing it and it never happened. So introduction of new products, including REITs, is something which we are willing to have a look at it, and SEBI will be very happy to receive a paper, to receive a suggestion, receive an argument in favor of it, and we will be delighted to have a discussion on that, and if we are convinced, we have no problem in introducing that. Not only this product, but any other product which is thought to be necessary. But in this conference where you are talking about investment, you are talking about the investment opportunities in this country, I would like to again reiterate that all of us, it's not only SEBI's job alone, it is the job of all of us to ensure that the products which are not strictly legal, the products which are in the grey market, they are brought back to the market. And in that we need the help of the state governments, maybe the central government, and also the entire investment community. We are going to come out with a set of investor awareness campaigns, and hopefully it will be out next week about some of these developments which have taken place. And my worry is, and I give you some examples, that if these are not curtailed, if they're not checked, people are going to lose money in large numbers. And when large numbers of people lose money, the credibility of the whole system is seriously challenged, is seriously eroded. So I'm seeking your help in spreading this message. So far as our current working is concerned, I would like to assure all of you that we are very happy to receive new ideas and new suggestions, and our entire effort would be to ensure that people have their trust in the market, and that is a fundamental mantra for us. If we are able to restore that, if we are able to strengthen that, I think rest of it will follow. I would like to thank all of you for being kind enough to listen to me, and I would like to thank the organizers for inviting me. I wish the conference all the success. Thank you very much.
Thank you, Mr. Sinha. And now may I request Mr. Niranjan Hiranandani to hand over a memento to our chief guest, Mr. UK Sinha. Thank you. Mr. Hiranandani to Mr. Ashish Chauhan. Mr. Hiranandani to Mr. Ananta Subramaniam. Thank you, sir. Now I would like to call upon Mr. S.N. Ananta Subramaniam, President, ICSI, to present the vote of thanks. Mr. Ananta Subramaniam, please.
Morning. It's indeed a pleasure to present a hearty vote of thanks to respected Shri UK Sinha, Chairman SEBI, for his profound words of assurance and trust. Before that, I should also like to mention Shri Hiranandani. Thank Hiranandani for raising the relevant issues in his opening remarks. Dinaben Mehta for setting the agenda for the seminar, and Mr. Ashish Chauhan for giving his perspective of relevance of this venue for this seminar. I also at this point of time thank the regulators who have made it possible today to be with us. Mr. Ravi Mathur, Secretary Disinvestment, Mr. Ramesh Abhishek, Chairman FMC, Mr. R. Gandhi, ED Internal Debt Management, Department of RBI. The entire galaxy of speakers for sparing their valuable time and being with us, all the moderators for conducting the program, our knowledge partner, FinSec Law advisors led by Mr. Sandeep Parekh, our principal sponsors, BSC Limited and Mr. Ashish Chauhan, who took a personal interest in conducting this program, our partner exchange, Mr. MCX Limited, led by Mr. Venkatraman, who provided valuable inputs in organizing the program, our silver sponsors, Birla Life, Sun Life Insurance Company, Reliance Mutual Fund and SBI Mutual Fund, Bloomberg for being our media partner, committee members of IMC Capital Markets Committee for conducting this event throughout the year as well as this particular event, Mr. Sadiq of Network FP for arranging for the webcast for this entire event, our co-organizers BSC Brokers Forum, Sher Khan, Network FP, NJ Investments, Ashish C. Mehta Investments, the press and media for covering this event, for all the participants who attended this program and made it a big success, members of ICSI WRC led by Mr.
Mr. Prakash Pandya, Chairman, Professional Development Committee, the staff of BSc Limited for assisting in making arrangements for this at this BSc Convention Center, the staff of IMC, especially Mr. Anand Adsul, who has been the backbone of all the preparations, and finally, all those delegates who have made it possible to make this inaugural session and the sessions which will follow an event to remember. Thank you so much.
Thank you, sir. Ladies and gentlemen, this concludes our inaugural session. I would request our dignitaries present over here for a group photograph, please. Thank you very much.